Well, after the recent interest rate increase announced by the Federal Reserve, you may be worried about how this could impact both your budget and your retirement savings. We were just talking about the stock market a few minutes ago. Here with some practical insights on what it means for you and your money is financial expert and host of the Good Money podcast, Derek Kinney. Derek, it's been a while. Thanks for being back with us today.
My pleasure, Jason. Great to be with you as always.
All right, I want to ask you this. Everybody's been, talking about what the Federal Reserve is doing. Some people understand it, some people don't. They just know that they've been raising interest rates. How does that actually reduce inflation, though? How does that sort of act as the brakes on the economy?
Yeah, how does that work? Well, here's what the intention is. When the Fed raises rates, it causes big ticket items to cost more money. Think about home mortgage rates go up. Interest rates on cars go up. And what that intends to do is cause people not to buy them or less people to buy them, which then drives the price down of things like houses, cars, other ticket items, which drives down inflation. Now, there's a lot of assumptions built in there, but the worst scenario, Jason, is this, is what if interest rates stay high and prices stay high? Then you have what's called stagflation, which is an entirely different set of problems that they want to avoid if at all possible.
But they're purposely, when you're raising interest rates, and people should understand this, when you're raising interest rates, you're purposely trying to slow down the economy. You're purposely trying to make it grow less fast and bring prices down and sort of make things calm down.
Yeah, sort of like when we all took driver's ed and we had a brake on our side and the instructor had a brake on their side, and the Fed is in the car next to you with the brake pressing it down to try to slow it down in case you don't. That's the bottom line. They want to slow things down. The problem, though, is this, Jason, is if they slow it down too much, it could tip the economy into a recession, which could be even worse.
I love that analogy, too, because I think a lot of us can remember that. I certainly remember that instructor, thankfully, having the foot on the brake pedal there. Where do consumers most quickly experience the impact of higher rates? Is it cars and houses?
Yeah, cars and houses, and here's why. For those people watching that have what's called an adjustable rate mortgage, an ARM, and the reason they would have gotten it is it was a lower interest rate a couple years ago and it saved you money, and you were probably thinking, my gosh, 5 or 7 years from now, rates will be lower. But as those come due, and rates right now are about 2% higher than they were even a month ago, that's going to cost you a couple $100 more per month in your house payment. But also credit cards. This is for people watching who don't pay their credit cards off every month. Many credit cards then reserve the right, which they will do, to raise interest rates every single month. So the bottom line is, if at all possible, try to aggressively pay off the credit card to save you quite a bit of interest.
Boy, and those ARM mortgages, we went through the same thing in 08 and 09. Derek, we've been seeing these wild swings in the stock market. Thankfully, today was a good day, one where you actually want to look at, what you've got there. Right. What's causing this, and do you think that this is likely to just keep going like this?
Well, I do think it's likely to keep going like this, but let me be a voice of reason to our viewers and say this. This is like Vegas, where people are putting bets on the market every day. Some people bet the market's going to go down today. Other people bet the market's going to go up. It's this tug of war that's going to go on for a while. But here's what people are looking for. On Friday this week, for example, housing numbers come out. That's going to show how many people are buying houses. It's also going to show what's called consumer sentiment, which is a gauge of how comfortable are average people like you and I about spending our money right now. If we feel less confident, that bodes poorly for the economy in the near term.
And we may see yet more volatility there in stocks. Last thing here for us, Derek, for investors who are saving for retirement right now, let's say you've got a 401k or maybe you've got an IRA, that sort of thing. What do you tell people right now? Because it just seems like, there's good days like today, but boy, there have been some harrowing drops in the stock market too, and you watch that balance just go down and down and down.
Well, you're going to want to have some Pepsid AC with you at all times. But also, I think in the long run, for people who are several years away from retirement or the younger viewers watching right now, this could actually be a very strategic time to put money in the market, be in your 401k and those well-established blue chip areas. Think the S&P 500, the Dow Jones Industrial Average, big behemoth companies that pay a dividend. If you're close to retirement, though, you may want to gradually take a little bit off the table and park some in cash. That way, if the market does drop, your entire portfolio is not in jeopardy, but you've got some, as I like to call it, opportunity money to buy while things are low.
Yeah, you got to think about your comfort levels a lot these days with this market. Derek Kinney, he's written the book on this. It's called The Good Money Revolution. Derek, thanks as always for being here with us and walking through all these sticky things that I think, a lot of us hear, but maybe we don't fully understand how they work.
Hey, my pleasure, Jason. Great to be with you.
Thank you.